Well, we've got one in the books. Today's Thursday, the 3rd of February. And if you don't like markets, just wait a week.
I started the radio show off today by asking an adage. I said, I consider myself a very positive person and do see glasses half full all the time. But there is an adage in today's world that we've used before that as January goes, so goes the market. As January goes, does February go that way? So I raised the question because it's just a realistic question to ask. It was a tough January. I think you reported that close to 5% the S&P was off for
the year, 4.7% for the year.
Year
But this time last week, it was off 10%.
Yeah.
So we've had some recovery. But I think if I had to give you some words of wisdom, we're going to see this again. So we're going to see the next 6 months are just going to be a slugfest. We're going to be up and down. If you look at historically what happens in midterm election years, this is setting up just like all the charts say it's going to, that you're going to wait until October, November, and then you'll see a spike in the market after the midterms have come and gone. So I hate to say wait till November, but you better have a little bit of patience and take advantage of things that are going to be selling for less than they are today when we have those dips.
And that's what we're doing. We are on the stock market side. We have a list of things that we're wanting to buy at the right price at the right time, and we're taking advantage of that. And then on the bond side, we actually, for the first time, I was thinking possibly ever. It is very few and far between. We actually sold 2 bond positions that were coming down in value because of the expectation of rising interest rates, and we just took the position that let's stick with a known. For the next 30 days, let's raise a little more cash than we would normally carry. That's your bond fixed position. Let's see what the Fed is going to be doing. Let's see if we can get a sense of timing on what they're doing. And instead of interest rates driving bond values down, we're just holding cash, and we'll reallocate that. It won't stay there this year, but we will allocate it as we see things unfold. So we are being proactive with the portfolios, and even though the stock market is off, for all practical purposes, the reports I'm seeing, we're off slightly, or we even are break even on a rolling 1 year basis.
I have a client coming in that's kind of that mid-variety type of portfolio, 65% in the market, 35% in fixed income, and now a lot more in cash, and off between 2 and 2.4%.
Right.
So we've recovered a lot of that back. So never like negatives, but again, I think we just have to get used to this for this year until we get to a little more solid ground after the
and you would say to us, well, if you guys don't think it should be till the second half of the year that I can make money, why wouldn't we just get defensive right now?
Because we're not always right.
Yeah, if it turned quicker, if in March we got a clearer view of what the Fed was going to do in terms of tightening, if we came out of if the supply chains begin to open up, the GDP last year ended at 6.9%. It's expected this year to be in the 4% range. We want to be positioned correctly so when it does begin to move, we're taking advantage of it. And your point from where January looked like it was going to a -10 to a negative number on 5 spot, that gave the understanding that you need to be in the market.
That's correct.
So that's what we're going to do.
Because in 5 days, we halved the losses, or the S&P is half the losses, I should say.
Let us assure you, we're talking to all our outside force of people that we gather information from. We are meeting on a very regular basis. We're having conversation. I had a client ask this. Do you have a plan of what to do in the event of geopolitical events, the Russia issue, the China issue? And the answer is yes.
Always.
We are talking about what to do. We know what levers we want to pull. We know what we would do. So we're being proactive, and we're having conversations on a regular basis. We would encourage you to call us if you have any concerns or just would like to see us or like to have a review. We do that. We're going to be calling you. And you should always remember, It is your money.
And your money matters.
We'll see you next week.